Hi, welcome to my YouTube channel Invest with Chikwesere. This is a platform where I teach smart investment ideas using investment platforms and tools like the stock market, real estate, mutual funds, ETFs, treasury bills, bonds, and others. So in case you are seeing my video for the first time, please do me a favor by subscribing to my channel, like, comment, and also share this video so that others, especially investors or people that are starting their investment journeys, can actually see this video and also learn from it. So today I want to share with you the mistakes that you must avoid if you must succeed in the stock market. You know, many people out there, everybody is saying the stock market is actually rewarding me, lots of hypes all over the world, on social media, people, praising their portfolio, saying one thing or the other. Nobody is actually talking about the mistakes that one can actually make that will affect their investments in the stock market. And don't forget, our stock market is also increasing your investment. It can also decrease your investment as fast as possible. So that is why you must avoid these mistakes that I'm about to mention to you. So number one is avoid chasing social media hype. Yes, avoid chasing avoid chasing hypes. There are lots of hypes out there. People don't take time to actually understand what their proposed company or the company that they want to buy their stocks, what they are into. They are not interested in trying to dig deep into this particular company. They are just interested about how to quickly cash out or how to quickly make money from that particular company. And most times you will discover that they will just enter into trouble. Yes, they will enter into trouble because that is not how the stock market works or company stocks work. You need to have the capacity to put in the work, to understand what you are dealing with. You need to understand. You need to understand a whole lot of things, not only about that particular company stock, but also about the regulators. Yes, the regulators, because the security of your investment is as much as important as your investment. For me, I even place more importance on the security of my funds or the security of my investment rather than even my investment, because if your investment is not secure, you may just lose them overnight. So people are chasing social media hypes a lot, and it's not really good. So you must have that capacity to dig deep. Don't be chasing social media hype. I know that severally I have mentioned it in this channel. Avoid social media hypes. Most of them are just opportunists trying to lure you into maybe entering into a place where you will regret. So you need to have that capacity to dig deep, go deeper, try to understand what that company is all about. That is, you must avoid any kind of hype. Avoid chasing hypes, whether in the social media, in gatherings, or amongst your friends. You must avoid hypes. Then the second mistake that most people do is not doing research. Yes, this one is coming from the number one point, because you are just busy chasing, trying to know what is working. You are not sitting down to make an in-depth research to really understand what this thing is all about. Some of us don't even understand what the company we want to commit our funds into is doing. Yes, we don't even understand their model of business. We don't even understand what they are doing. So we just want to just put in our funds and then cash out. And most times you discover that you continue losing monies. Yes, you continue losing monies. When you open your social media, you see lots of people talking about this stock, that stock, this stock, that stock, and nobody is talking about, doing proper research to really understand the reasons behind the recommendations of those particular stocks. So you need to help yourself. You need to master, you need to have the capacity to dig deeper, to make researches concerning particular companies that you are interested in. So you need to avoid not doing research. And that will take us to the next mistake. And the next mistake is over trading. When we say over trading, we are talking about emotional trading. Today you are here, tomorrow you are there. You are just jumping up and down. For me, I even I have developed this capacity that most times I don't even look at my portfolio for a long while. Sometimes I do it in quarters. After the first quarter, I will come back, look at my portfolio, and then I will do some adjustments, and then I will move on. Because if you are looking at your portfolio on daily basis, you maybe today you will now discover that company A is actually generating so much profit. The stocks of the unit cost of company A stocks is actually going so up, and the B that you have is going down or is still stagnant where it is. And most times you will discover that you quickly go and sell your B in order to buy A. And when you buy the A that is already going up today, tomorrow you will discover that the A is now stagnant, B have started going up. So you will now start, moving up and down over trading, and then bringing so much emotions into, decisions, which is not good. So making decisions under emotional instability is not really good for stock market investing or stock investing. So you need to really avoid over trading. And the next one is ignoring diversifications. Yes, ignoring diversification. Today you hear that the stocks that are actually very high or that are doing very well today is the banking sector. So you just pull out all your monies or the monies that you have for investments or your funds. You just take all of them and then you put them into banking sector. That is not how it works, because the danger there is that if by tomorrow you wake up and you discover that maybe there is a particular regulation from CBN or wherever affecting the banking sector, all your portfolios will be down. Yes, all of them will just slump down. And probably if the banking sector of that particular country or wherever have some kind of issues, you will discover that the whole stocks of that sector will just be down, and it's going to affect you as an investor, both emotionally and financially. So that is why you have to learn the power of diversification. So you shouldn't avoid diversification. Pay attention. All your stocks, all your portfolios, your portfolio shouldn't be in one particular, sector of the economy. Diversify. You can match manufacturing, or you can add manufacturing with banking, and then assurance and all the rest. You can just put them different area, ETFs, bonds, mutual funds, even real estate. You can add them. There are some ETFs that also cover real estate. So you can just put them all there, so that when one sector is actually, having some levels of issues, you will not be hit so hard. So you also have some other sectors to, to cover up for the hits, at least for that particular point in time. So that is why you shouldn't ignore diversification. Diversification is very important if you must maintain a productive and a profitable portfolio. And that will take us to the next mistake that you must avoid. You must avoid timing the market. Yes, most of us time the market a lot. We are just monitoring, trying to, when to know or to predict when a particular stock is down, so that we can quickly, jump inside, then make profit and then pull out. Let me share my story. Something that happened to me some time ago when I was trying to learn how to navigate in the stock markets. I'm talking about the US stock markets now. So this particular stock, that was Shopify. Yes, Shopify. I bought Shopify when Shopify was around, I think $20. Yes, I bought Shopify when it was $20, and before you know it, Shopify now increased to $25. I was like, wow, that is $5. I was able to. I was looking at it, so it will go to $25, it will come to $24, it will go to $26. So it was moving up and down, and that was how my blood pressure was also increasing, because I don't want to lose this particular, profit that I have made. So I was monitoring it, and before you know it, when Shopify now hits about $30, so I was making roughly around $10 per unit. I sold it. I sold my Shopify and I was making $10. Oh, that is wonderful because I made $100. That is 10 times 10 units. That was $100. So I was like, wow, I did well. So before I knew what was happening, I now discovered that Shopify have moved from $30 to $25. I was like, wow, I really made a nice decision selling this stock when it was, very low. So I was not saying, so I was waiting for Shopify to hit to $20 again so that I can enter again. Before you know it, Shopify now moved to $30. It was too expensive for me. Before you know it, it moved to $40. It was too expensive for me. Before you know it, it moved to $70. I knew that I have really, I have made a mess of myself. And then before you know it, Shopify was nearing $100. I nearly fainted. I nearly fainted. But why did that happen? Because I was trying to time the market. I didn't just leave my stocks and leave it because if I have left my stock there, I think Shopify at the time reached up to $141. Just imagine, I could have been making about $121 dollars per unit. Imagine how much I would have made. If I times it times 10, that's about 1,200 units. And when you multiply by the exchange rate, that is more than 2 point something million or 3 point something million, as the case may be. So that is how dangerous timing the market can be for you. So you need to avoid it. It's one of the mistakes that you must avoid. Instead, develop a consistent approach. Decide for yourself, my income is 50,000 naira or $50 a month. Then in that particular $50, what I'm going to be doing is that I'm going to be making sure that 10%, that is, let's say 5,000 naira or 20%, 10,000 naira will be going consistently every month in selected stocks. Remember, diversify in selected stocks. So every month you know that it's going there. You're not even looking at your portfolio. It's just going there, multiplying. You are reinvesting from your dividends. You are reinvesting from your share appreciations. You are reinvesting from your capital gains. You are just reinvesting. So that is actually how we call it compounding. That is how to make so much money from the stock market. So you need to learn how to avoid timing the market. And the next one that most of us, next mistakes that most of us make is using emergency funds. Yes, using emergency funds. Probably you have school fees to pay in the next 3 months, or you have house rent to pay in the next 2 months, and then you decide as a smart person you want to just put this money into stock market, and maybe in 3 months it will now multiply or double for you so that you pay your rent and still have money. Yes, they say that the rich people multiply their money before they start spending, but that does not work for stock market. So stock market, you need to adopt a long-term, approach, a long-term strategy. If you don't adopt a long-term strategy, that means you are going to be hit, because short-term does not reward people that do not have patience. It rewards only people that have patience. So what if you now say in the next 3 months, I'm going to take this money to pay my rent, and you discover that the stock price or the company stock that you bought is rather going down instead of going up? What will happen to you? Emotions will just set in, and before you know it, you sell the stock because you really need to solve this short-term problem or short-term issues that made you to even keep that money in the stock market. Personally, I have experienced this a lot, and it's not good. So you need to avoid this mistake, as fast as possible. Maintain a consistent approach. Move your emergency money out of stock market so that you will not be dealing with emotions every day. So that is it. You need to avoid using emergency funds in the stock market. And the next one, the next mistake that most people make, and you must avoid it, is giving up too early. Yes, giving up too early. You need to avoid giving up too early. I've been stressing it again and again and again that the stock market rewards patience. It's a long-term strategy to wealth building. If you want to consider a short-term, you need to a short-term investment. You can look at treasury bills. Yes, you can look at treasury bills. And in this channel, I did a video on that, how to invest in treasury bills. Look out for that video and watch it. So treasury bills, at least from the point of subscription, you already know how much you are going to earn at the end of that business cycle. You already know. That's why it's called one of the safest, business investment models that you can actually think of. So they just, the amount of money you are going to get at the end. That is treasury bills for you. There are other options like high rate savings accounts, high interest rate savings accounts. There are lots of short-term investments you can actually look out for if you know that you're going to give up early. Because stock market, sometimes you can put your money, like for instance, what is happening to me. But for me, I'm using it to buy more because this is actually the best time for me to enter. But I'm not advising you to do that. There's a particular stock I bought, and that stock I have lots of them. I bought that stock at the rate of $95 dollars 45 cents. I bought it at $95 45 cents per unit. And before you know it, because of some levels of competitions, lots of business models, threatening and challenging this particular company, and before you know it, as I'm talking to you today, that stock is in $70 as of the time of making this video. $70. So imagine if I have to start selling that stock today, I'm going to be losing $25 45 cents. So you see, that is not actually how it works. So I have to play long-term game because as I'm talking to you, that particular stock is still undervalued. So I'm buying it more. I'm even looking for ways to increase my stake at this moment because I know definitely it's going to increase within a 1 year roadmap. It's going to increase. It's going to move beyond the price that I bought it. So that is how it works. It doesn't, so imagine if you are someone that have, short-term perspective to stock investing, that means I will sell it off now, then I'll be going home with $25 45 cents losses. And that is not good. You'll be losing your money. So that is why you must learn how not to give up too early, especially when you know the company that you're investing your money in. Like what the company I'm using as an example. Now everything is fine. In short, their last quarter report, they made billions of dollars in profits. There was actually no problem. Everything is so fine, and the subscribers in that business model, they're increasing in millions every day. They are doing so well, but the problem was that there was a threat of another company trying to become a competitor with them, and all of a sudden the market reacted with sentiment, emotions, and then the stock is kind of down right now, like it plummeted right now. So that is it. So imagine if I have to follow that emotional trend, then I sell off my stocks, then imagine what is going to happen. So that is it. That is why I'm saying avoid giving up too early, you know, in the stock market. Then the last mistake that you must avoid if you are interested in investing in the stock market is not subscribing to this channel. I must tell you, this channel is going to be teaching you everything you need to know about stock investment, not only stock investment, but also in smart investment ideas like high interest rate savings, the bonds, mutual funds, real estate, and then comparison between all these kind of financial instruments or financial investments and how to leverage on them to build the kind of wealth that you want. In short, in time to come, we are going to be sharing, I'm going to be sharing my own portfolio of the things I'm buying at the moment so that maybe beginner investors can actually, follow my pattern and understand why I'm buying what I'm buying. So that is why you cannot afford not to subscribe to this channel. So please subscribe, like, comment, and also share this video so that others can see it. I will see you in the next video. Bye for now.